From one retail investor to another. This is Trader72. Welcome back to my YouTube channel. We've had a little mini break since last week. Very busy week last week with obviously the trading updates from the big four and amongst many others. It's been an interesting week and a full week. I hope you guys have had a great weekend wherever you've been doing. Yet again, another kind of chilled out weekend, a bit of sports, bit of golf, bit of tennis. It's been very pleasant indeed. It's actually a bank holiday weekend this weekend, so extra day on Monday. But you know what, guys? I am here doing another deep analysis for you guys. Please subscribe and like. Make any comments. Obviously, the more comments, the better. I had a very successful last upload for the Microsoft analysis. And service now, which was great. So thank you guys for watching and clicking, and please subscribe because 99% of you have looked at it but not subscribed. So the more subscription, the better, obviously. And I'm sure that every YouTuber says the same thing, but it is what it is at the end of the day. So without further ado, let's break today. So today is, well, about Walt Disney and Disney Channel. So a company, a true heavyweight of the global entertainment business, but all to be proved at the moment. It's going through a bit of a proving stage. They've got a new leadership in a chap called Josh D'Amaro, who's just taken over from Mr. Iger, who obviously was Mr. Disney for the last 20, 30 years. And it's currently sitting at a bit of a crossroads in terms of where they're at the moment. New beginning, new leadership. And we're going to have a quick look, really, in terms of, as I said, Trader72 is all about looking at a more simplistic way for some of you guys who've just come in or are new to the business in terms of going into the market as retail investors, or maybe even people that like to just talk simplified, and that's what I'm all about. So I'm going to be pretty much black and white. I'm just going to look obviously at various different situations. As we can see from the screen there, obviously it is Disney. It is a land of Marvel and dreams. It obviously has a major amount of entertainment in various different pies, of course. So I think that's important to keep that in mind, that Disney is not just Disney and cartoons. It has a lot more than that, as I'm sure you guys know, either from your youth or when you were children, going to these theme parks, which obviously is a main part of the business. So the question is today really, is this at a discount for a start, the actual stock, the actual price, or is this a value trap? So let's dive into these numbers, and let's start with what Disney's about, break down the businesses, break down the numbers, get an idea of the share price and its intrinsic price, which you guys, you know, I'm very big on. If it qualified for the 4 M's, which is another part of my criteria, and then maybe my final thoughts on whether or not to invest potentially in Disney or not. Now, remind you guys, I'm not a financial advisor in any way, or shape. I have no finance background, so this is purely advisory at this stage. So do please make your own due diligence before you invest in whatever I put up in terms of analysis. So let's start. Disney business model, guys. So I think, you know, pretty much we have an idea of the business model of Disney. We all know what it is in research, but let's just take it apart for you guys to be exactly aware. Because when looking for a company in terms of research and before you invest, which is I think the best part of investing for me, the getting to know a company and really getting to get to the bare bones of it, and actually really understanding how business works, which I think is fascinating. Whether it's in the SaaS business, the entertainment business, the financial business industry. For me, obviously, Disney is a little bit closer because my first normal job really is more the entertainment business. I've been in the film business for 20 odd years, so for me it's kind of close to home and understanding the business quite well right from the start, as opposed to maybe more SaaS side or software side or financial side, which obviously is not my initial background. So Disney business model is broken into 5 parts. Entertainment, which obviously is the creators, producers, content across movies, TV and originals. direct to consumer, which obviously is the streaming business, which is obviously quite an interesting part of the business there in terms of cable. Obviously Disney Plus, Hulu, and ESPN, which I think is still kind of the golden child of that side of the business. Experiences, which they call experiences, which is obviously theme parks, resorts, cruises, experiences, and etc. Obviously, consumer product, the merchandise is obviously all important. That goes without saying in terms of toys, t-shirts, you can name it. They do charge for that. Let's not forget, as I'm sure most parents will probably know when they go to Disneyland, whether it's Paris or the US. International and licensing. Now, that's not something I know a lot about, but in terms of content distribution, international operations, so certainly has a very powerful IP in terms of its brand. It's nobody else has that brand in terms of just not even just the Disney characters, but the theme parks, the studios. Obviously, very hard to beat that. Obviously, there is competition in any like in any business, but it certainly is in terms of the four M's, in terms, I think, of the moat, which we'll come to a bit later, a very strong point, sticky point there. So it can obviously create, engage, monetize, which obviously is very important for any investor in terms of driving revenue, streaming, parks, merchandise, reinvesting into the business and strength. So that, I think, is the business model of Disney. So breaking down Disney's revenue and income stream. Now, this is where it becomes a bit more juicy for us investors. I think this is where you really get to know what you're investing your every buck into. So it's interesting to break down a business, especially of that scale at this moment. So as you can see from this graphics there, obviously it's broken, as I said, in experience, entertainment, sports, and direct to consumer. So let's break this down. Experience at the moment is obviously park and cruises is 36 billion. So 66% year on year so far. These are pretty much the latest numbers that I've come up with. Entertainment down slightly, which is always up and down, but minimum really 2% down on year. Sports, ESPN, which is obviously the sports channel, down 5%. And direct to consumer. Now, if we're looking at the market share of this, down to your pies there, in terms of revenue breakdown and operating income, you can see who is the biggest chunk here, which is obviously the experiences, which is the park, cruises, and products. It has 39% of the total revenue there, of the 94.4 billion, which is 3.6 year on year up at the moment. And you've got obviously entertainment, which is obviously another big part there at 45%, which actually, ironically, you'd think the experiences would be the biggest one. But it is actually on the operating income side at 66% income. So it is an extremely valuable operating income for Disney, with 11.6 billion, with entertainment following second with 16% only. So quite a large, really a massive experience. The experience is really the main income driving there for Disney, followed by sports, which is barely 12%, and direct to consumer at 6%. So it looks to me as if at the moment, year on year, the experiences is the department that probably does the best out in Disney, for sure. Domestic parks, international parks, Disney Cruise as well, which is huge. I've seen some of their boats; they're pretty big. So the revenue there at 36 billion and an operating income of 11.6 billion, both up on the year. All the rest is pretty much in the red bar. Hulu and direct-to-consumer there. The interesting thing about, of course, the direct-to-consumer, which is obviously Hulu and Disney, this is a subscription-based business, always a good thing. Obviously, I own top like Adobe. We did ServiceNow recently, which all have subscriber businesses, and obviously subscriber means regular income from month to month. People paying a regular subscription is good for any businesses. So that obviously is a good thing. In terms of sports, well, it has a strong, obviously, portfolio of events. Obviously, we'll come to the point of the cord cutting of the cables, which is, I think, a big issue going forward. That is possibly one of my bone of contention, I think, with Disney at the moment, to see where that department goes. You know, the network are slowly but surely disappearing. People watching TV, as we know from YouTube, very differently. So that could be an interesting part, but still, you know, nevertheless, part of the revenue income stream for Disney. So I think in terms of that side of it, we kind of get an idea really of what the biggest chunk of business, if we take the business apart, what are the two biggest earners? For sure, experience and entertainment are at the top. But in terms of actual operating income and net income, this is potentially experiences is definitely the biggest part of the business. So let's get to the valuation, guys, in terms of Disney as a business. Now, the market cap, let's break this down, because you know, you guys, I kind of like, the first thing I look out for is the market cap versus the enterprise value, which basically gives you the difference between these two. It gives you the actual debt of the company. Now, it's quite a large debt. Now, obviously, Disney as a business has obviously heavily leveraged its side, obviously, the company, and it has a, you know, compared to some of the analysis I've done so far since I've started this YouTube channel, probably one of the biggest total debt is Disney so far, with a whopping 45 to 47 billion pound in dollars. Sorry, I keep saying pound, guys. Sorry, apologies. Dollars. So that's quite a large chunk. Now, obviously, let's have a quick look at the revenue here. 94 billion at the moment, that's a quarter. So net income at the moment is between 8.7 and 9 billion. If you average that out on a 5-year net income, it is obviously up. That's always good news. Free cash flow, which you guys know is absolutely key to any business. It's even more important than the net income. So free cash flow is the actual cash after operations. Everything's gone. It is the lifeblood of the company in terms of reinvestment, paying dividends, etc. CapEx investment as well. Now, in terms of free cash flow, again, very impressive. 8 to 10 billion free cash flow TTM, which obviously is trailing, which is currently average on the last 5 years. It has been between 6 and 8. So definitely an increase in free cash flow, which is, you know, very important and a big tick for the company. There's a dividend yield there that's kind of pretty reasonable at 1.2%. And let's have a quick look at the gross margin. Now, the gross margin is pretty decent, actually, 35 to 40%. Obviously, it's not tech-based, which is, you know, we've looked at last week with even someone like ServiceNow or some of the other bigger tech companies, which are looking at 60 to 80% gross margins. But 35 to 40 is pretty decent for a company that's been going for that long and is that well established. Profit margin between 9 and 10%, which is just about right in my criteria. Revenue growth is between 4 and 6% of the last 5 years. EPS growth between 8 and 10%. EPS obviously being quite important, but that's on average where it's at. Now, interestingly enough, the P/E ratio is currently at 15. Now, it is the lowest it's been in 5 years, which means that Disney, at this moment, based on the P/E ratio, is quite cheap in terms of share price. Again, that will be confirmed by the discounted free cash flow that which we obviously buy to, which gives us a intrinsic price, the true price of the stock, versus obviously a margin of safety. So I think at the moment, you know, looking at that, that's quite cheap, considering that the last 5 years Disney's been between 25 and 30. So pretty good there. PEG, which is obviously an interesting, that is obviously a very old-fashioned, you know, matrix, which anything under 1 means that it's quite cheap. It's currently at 2.5 to 3. So again, a little bit of an imbalance between the P ratio and the PEG. The PEGI even, we call it. But, you know, it is what it is. So that's pretty much the breakdown of the revenue breakdown, as you can see there. Experience 36, entertainment at 42, revenue at 17 billion, direct consumer 24. But as you can see there, that is where we are at the moment. The revenue growth so far is 5% year on year. So the numbers are pretty good. I mean, I don't think there's anything, you know, free cash flow is pretty good. It's on the increase. Yes, there's a debt there, which is worrying. Well, I mean, I think that it can pay back its debt, but how quickly can it pay back its debt? Obviously, it's going to be slightly longer than other companies that have their free cash flow that can pay off in, you know, less than a year or two. I would say that obviously based on 10 billion, it will take a little bit more time in terms of debt versus equity. So something to bear in mind there, guys, before you invest. The 4Ms. So the 4Ms obviously is one of the criteria I've picked up from Phil Town. Please do check his book, Rule 1, which I think is amazing. I learned a lot from the value investing side. And one of the 4Ms obviously is one of his criteria, which is meaning, moat, management, and margin of safety. The margin of safety will come back when we do the DCF model, so don't worry too much about that at the moment in terms of that side. But does it qualify? Does it tick 4 out of 4 or even 3 out of 4. And I think that's a really important part of the criteria when looking at its stock. And I think it's a brilliant way of actually just taking apart a company and not spending, 2-3 weeks looking into, the moat, the management. It can be worked out fairly quickly by doing some good research. And finding out if the business does actually reach these criteria. So in terms of meaning, number one, meaning means, do you understand the business? It is a critical point, guys, in terms of understanding. If you don't understand the business, don't invest. It's a world-class entertainment experiences that bring joy and connection to families. Nobody will doubt that fact. So it's a big pass. It's strong, timeless. It will be around for the next 20, 30, 40 years. I have absolutely no doubt that Disney is going to be around. In what capacity it will be, that's obviously something else that we'll have to see. It has to move on with times, but it has got some very classic films and characters that we are all well aware of. Moat. Now, that's an important one for me, moat, because that gives you an idea of the actual business and the moat, as it says. It says what it says on the tin, the protection of the business. How much has it got a foothold in that market? Is it a number one or even a number two? Is it a duopoly? A bit like S&P Global and Moody's, which own that market, which cannot be replaced, cannot be turfed out or even invaded, if you want to look at it that way. I mean, I love history, so I look at a moat as more of a defense moat, defending your castle and not being invaded. So I think from that point of view, that's second to none. Iconic brands and IP. Star Wars, Disney, Pixar, global scale distribution, high switching costs, Disney and bundle ecosystem, network effect in streaming and content library, pricing power and theme parks. Really, don't think there's a lot there to not understand about Disney and the foothold it has. Nobody else has that business or IP in any way, source, shape. So that's a big part. Now, Bob Iger obviously has a proven record, returning in 2022 for the second time around. Probably not as successful as the first time around, I would say. And strong capital allocations, did major share buybacks, which obviously everybody likes if you're an investor, especially when bought at a cheaper price or at a 52-week low. Refocusing strategy, park first, streaming, profitability, ESPN growth. So I think from that point of view, the management has been on point. Damaro up for its new jobs. He's been, I think, promoted internally. So, whether or not he will pick the baton, that is something else to see. But let's see what comes out of the new leadership. Again, that could be something that you guys need to have a look at, whether or not we think this chap can take Disney forward for the next 20 years or so. That's where we are. I think it kind of ticks pretty much 3 out of 3. And pretty much, I think if we look at the share price at the moment, potentially 4 out of 4. So no problem there on the 4Ms as far as I'm concerned in terms of the actual business. That's where we are. As you know, guys, the bull case and the bear case for Disney, I like to do both because that gives us an idea of both sides of the strengths and weaknesses of the business before you invest. And I think it's very, very important that you guys do a balance on that you just don't, because some people will get very excited about a company like I used to. And again, this is me learning from my experiences for the past 10 years as a retail investor. I've made every mistake you guys can think of. And the whole purpose of this channel is to kind of, maybe slightly see where things can go wrong or not. So I certainly learned a lot in those 10 years from myself and reading other people and talking to other people and so forth. So one of the things to do is obviously when you get very excited, you don't see very much the bad side of it. You've been told all the good things obviously through the internet, but it is important to look at also the negatives, which will give you an idea of any potential up and coming issues. But or current issues even. So the bull case, very quickly, unbeatable assets portfolio, we've gone through that already. Experience segment in cash machine, park cruises, experience drove $19 billion operating income in 2025. Highest segment, obviously. So we know that that's obviously helped massively. Streaming, turning profitable, believe it or not. Obviously I know that a lot of people have cut the cord in terms of cable, but it seems to be still doing okay for Disney at this moment, obviously. And again, foreseeable issues there going forward. ESPN has been remain valuable to them with obviously the $17 billion revenue. Leading sports brand, strongest live content, still got some great contracts there with various different sports. And long-term compounding machine, 15% annualized compounding. So again, it's been, if you've been with that stock for the last 10, 15 years, you would have made a certain amount of money on Disney. Although quite stagnation at the moment in terms of share price. So really the bull case, Disney owns irreplaceable IP, cash generative assets, and executing a turnaround. Patient investors can be rewarded as the transformation compounds. So it's a slow compounder. It's not one of the big tech companies. It's not as exciting, but it is still a big brand, recognizable brand. The bear case, valuation not cheap. That is debatable, that in terms of where you're looking at it. That's not, I would think, that what I would be worried about. The high debt, which I've mentioned, $45 billion plus total debt, higher rate for longer increase interest expenses. That could be an issue in the long run in terms of versus, you know, bashing their free cash flow to pay off some of the interest on that debt. So that, I would say, something to look out for. Linear TV, how long will that be around? Structural drag, declining TV networks, ABC, Disney Channel. I don't think they'll be around for much longer. That's my opinion. Again, that will be my final thoughts. Intense competition. I mean, you know, Netflix, Amazon, the big three there. YouTube, as we know, looking at it right now, I think is going to be something that Disney will have to deal with at some stage or another. And parks growth could slow, streaming could stall. That also could be an issue. So Disney faced multiple risks: valuation, debt, competition, execution, like a lot of companies, to be fair. And obviously, you know, content fatigue. Have we had enough of the superheroes? The Marvels seem to have reached a bit of an impasse. I think they've had a tremendous run with Star Wars, but let's be honest, for me, as an initial Star Wars man at my age, the first three were the best. I think they've actually, you know, overdrowned that Star Wars brand. Some of you may well disagree with me. I think there was obviously some good ones there. But how long, in terms of business, will that go on for? Parks, well, obviously that will be down to consumerism as well, which we'll come to in a minute. And ESPN dilemma, the rising cost of sports rights is rising. And can it compete against the Amazon of this world? Even Sky, which we know very well here, Sky is going to struggle to compete even for the Premier League contracts, I think, within the next few years, once they might renew another time. So I think there will be the same for ESPN. So I think there's obviously quite a few issues there to look out for Disney, which you guys need to keep, maybe not just for now, but for the future, versus obviously the bull case. So that's the bulls versus the bear case, guys. Just bear that in mind, and please do take a further look. DCF model, guys. Now, this is what the most key point for me, the true worth of the stock. That gives you an idea of the last 10 years and future 10 years of free cash flow as it stands. And this will be very important in terms of the share price. 8 and 10%. That is being fairly conservative in its price. Again, you guys can look at maybe less than that or more than that. I mean, there's a case for pretty much everything in terms of growth rate. But my understanding would be that I think Disney still has about 10% growth in itself. Terminal growth obviously is GDP, so 3% beyond the 10 years, and a discount obviously where money obviously changes over the 10 years is still at my usual 8%. Now that gives us $130 of intrinsic value share price, which is currently the share price is at 102. So that gives us a good 20% of margin of safety, which is not bad. But still not in my criteria of what we would be looking for at 25% minimum. I think that gives you more of a safety. If the share price falls quite hard, at least you've got that 25-30% already factored in. So that is the whole point of the MOS, or the margin of safety. So I think that's something you guys need to bear in mind. Now, some of you may well disagree on the 10%. You can play around with that. It obviously that will bring the intrinsic price down by quite a bit. I still think that that's the kind of the value is about right. I think for the last 5 years, it's on average between, I think, 6 to 9%. I've increased it slightly and taken, a bit of a leap of faith in terms of what I think the growth rate will be in terms of that. So if you guys think that it's the base case, there's 100, you could be looking at 102 to 130. 156 would be a very extensive growth rate for my liking. So as far as I'm concerned, that is the intrinsic price, which does give it a margin of safety and does give it a slight discount at this, or a good discount, but not potentially in the criteria that I would be looking for. I think so, guys. the final thoughts of this analysis on Disney. Now, I think we can break it down. I think I've kind of mentioned most of it as we were going on, but let's recap on what I feel Disney's final thoughts. So my thoughts are that at this precise moment, I would not invest in Disney at this moment in time. One of the major factors I've just mentioned is that the margin of safety is not quite there for me yet. At 20%, I've said that 25% is my minimum take, and you have to be quite rigid in what you think is right. So I think there's also other issues with some of the businesses that Disney have in terms of the actual cable. So I think cable will not be around that much longer. I think eventually people will watch it on streaming mostly, and whatever the future may bring. And I think that's people like ESPN, Disney Plus will eventually struggle. They are, I know, streaming out now and going towards that, but can they compete against some of the bigger boys in terms of that competition? I think as well, consumerism at the moment, people consuming is very up and down. So the parks and the themes of the parks can be quite difficult to manage when there's a downtime, and that can obviously add to the costs. So Disney's old media, it's got high debt as well, which obviously is a little bit concerning, and the streaming is a drag. On the other hand, obviously it has a massive global IP, brands that you will always recognize, that most of us will know, and I'm pretty sure for the next 50, 100 years, irreplaceable assets in that respect. It's got iconic assets, experienced businesses, streaming turning at the moment profitable, and as I said, it's where does the business go in the next 10 years is my concern. So I think the uncertainty still leaves linear TV in decline, ESPN costs, execution of streaming just turned profitable at the moment. I know they're going into that, but that will take time to turn it around. Cyclical parks can be impacted by economic downturn, which at the moment we know there's an inflation issue, there's the war in the US, which again, that will all trickle through the US economy eventually. So again, that could affect, I think, potentially the company as it stands. So just to reiterate again on the Disney situation, just again to prove their new CEO also coming in, I think that's all going to be another interesting point. I think he's got 6 to 12 months to really show his true colors and throw the kitchen sink at it in terms of, you know, making more income and more streaming and turning it around. I think that's something that's a big question mark. Opportunity and cost, I think Disney currently slow and steady recovery play. It's not high octane. It's really for value investors. Macroeconomics, obviously sensitivity is a big issue. I think, you know, yeah, exactly. I mean, at the moment, £6,000 for family vacation on $15 a month streaming sub is the first thing people cut. There's a plus and against. In my case, I think there's more minus than pluses at the moment. I think if we could see the share price maybe fall under 100, let's have a quick look at actually where the share price, so it'll give you a good idea of the entry point. But that's kind of where I'm at really with Disney at the moment. So there you go, guys. The share price at the moment, as you can see, for the last, based on the 1 year, took a massive dip, obviously, back in March. And it has made a slow recovery back up from the lows of $90 odd a share. It peaked at 105 and it's now gone back to about 102 and steady. Now the beta on that, which obviously gives you the idea of the where the market is. So the market is volatile. The stock as volatile. Anything above 1 means that the stock will move by an X amount percentage with the market. I think beta 144 is quite high. Something to bear in mind if you are investing on a short-term basis more than anything else. As you can see, 52-week low at 89, 52-week high 124. I think the next earnings update is the 6th of May, which is about a month from now-ish. So again, there could be an interesting entry point at some stage if you guys were looking to invest. I would suggest that from my point of view, and again, this is only advisory, so please do your own due diligence, as I said at the beginning of the show. I think I would be looking at no less than about 85 to 90 for me in terms of entry level. That would give me easily over 25% discount. So that's my take on a potential entry point if I was to do so. So yeah, that's where we are, guys, really, on this one. That's my analysis on Disney. Let me know what you guys think in terms in comments, if you agree with me or not. I think it certainly is an interesting business, an established business. I think that if you were in it for the next 10 years, it could be a very good compounder. But I think it has also some major issue with debt, with the cable TV, with the economy, and I think there's potentially some better options out there precisely at this moment. Now, if it was to fall back to the price I mentioned just now, I think it could be potentially, a small dip, a small amount of money to start off with, and see where the share price goes, whether or not it goes back up. So yeah, guys, that's it pretty much. I'll have a few more for you guys this week. Please subscribe and like and comment. The more comments, the better. Let me know what you guys think. And that is it for now. Onwards and forward to the next one. I should have another analysis for you guys this week. And we'll go from there. So from one retail investor to another, this is Trader 72. Over and out. See you soon, guys. Take care.